Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered.
Hello. Thank you for tuning in to the GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I'm your host, Virginia Lucci, coming at you live from my house in historic Montgomery, Alabama. Today, we'll be covering your Wall Street Week in Review. We're going to take a look at the second quarter earnings for more of our top stocks. Perhaps the most interesting of all is Tesla. And in our third segment, we'll be taking a deep dive into the current state of the economic recovery. If you stick around till the end, I'm going to give you my top 10 investment apps and give you a hint into what we're going to be covering the next time on the GSMC Financial News Podcast. Before I go any further, I want to take a minute to formally introduce myself. You may know my name, but you may not know anything else about me. So, again, my name is Virginia Lucci, and I am a lawyer and a financial planner. I live in Montgomery, Alabama, but I was born in Chicago and raised on Long Island. So if you hear a little funky accent, that's why. I'm married, have a wonderful husband, and two wonderful stepchildren. My stepdaughter is 14, and she's going to be starting school in a few weeks. Obviously, we don't really know how that's going to look or what's going to happen with that. So we're all kind of on our toes waiting to see what's going to happen. My stepson is 18, and he's supposed to be starting college in a few weeks. And again, we don't really know what that's going to look like. So our household's in a little bit of chaos, but I think we're feeling like a lot of American families really not knowing what the next few weeks are going to bring. We also have 2 cats and a dog. So I'm hoping they're not going to make an appearance on today's pod, but if you do, just know that Oscar, Tommy, and Lily are in it to help you make sound financial decisions. So let's get into it. First, as always, we're going to start off with the Wall Street Week and what's the top news. First and most important top news of the day is unemployment. Thursday, jobless numbers were released for the week. The numbers were not good. Jobless claims rose more than expected for a second straight week, hitting 1.416 million in the week ending in July 18th. This was according to the Labor Department. Estimates were expected at about 1.3 million claims. So we're making a significant increase in the jobless rate. Why? Estimates guess that it's because of the resurgence of COVID-19, especially across the Sun Belt, and cities like Houston and Phoenix are really feeling the crunch. Cases are rising here in Alabama, and we're kind of seeing what's happening with that as places are starting to close again. Other companies and small businesses that are remaining open are really struggling financially. Some are filing for bankruptcy and others are increasing layoffs. So this would be the second round of layoffs since the pandemic began. So what does this mean? There are going to be more forecasts for third quarter expansion to be revised down. Expect everything from retail sales to consumer confidence are going to take a hit. In other news on the street, the Dow Jones Industrials moved down 0.5% early Thursday after the jobless numbers were released, while the S&P 500 dropped 0.2%, and the tech-heavy NASDAQ composite fell to a 0.3% loss in the morning trade. So we're already feeling the unemployment numbers affect the street. It's not a significant loss, but again, it's not a consistency that the economy is rebuilding. Among exchange-traded funds, Innovator IBD 50, FFTY, gained 0.5% Thursday morning. The ETF of top growth stocks is about 2% off its 52-week high. The NASDAQ 100 linked Invesco QQQ Trust, QQQ, ETF moved down 0.3%. Meanwhile, the SPDR S&P 500 ETF, SPY, dipped 0.1%. Within the coronavirus stock market rally, which may or may not exist, the tech-heavy NASDAQ is up 19.3% overall for the year through Wednesday's close. So, again, we're building, but it's not a steady build. The S&P 500 is up 1.4%, while the Dow Jones Industrial Average is down 5.4% year-to-date through the July 22nd close. This is concerning for me because the steady gains are not being sustained. So I think that we are nowhere near the end of the economic disruptions. So keep that in mind when looking at our other investment opportunities. Stock futures had risen earlier Thursday after Tesla's earnings beat Wall Street estimates, and Twitter reported an increase in their growth. Tesla rose 3.31% to $1,645 after the electric car maker topped earnings and revenue estimates for the second quarter and said it could exceed 500,000 deliveries this year despite production disruptions from the coronavirus pandemic. So Tesla is killing it, at least theoretically. We have yet to see the 500,000 deliveries, but it's looking pretty good. Twitter did not fare as well. They announced a wider than expected loss for the second quarter amid a plunge in advertising revenue. The stock did rise 5.2% to $38.86, however, on a surge in users and traffic. So there's good news yet for Twitter. Personally, I think that they were affected by the Facebook advertising boycott of last month, and I don't know how that's going to affect the company long term. Also, like we discussed last week with Netflix, I think people have signed up, created new accounts to a critical mass, and I don't see a lot of new user beginning Twitter, so we might not see a lot of growth for a while. Investors are also weighing the possibility of more government stimulus, which we'll talk about in a later segment, against a rise of tensions between the U.S. and China. As you may know, the U.S. abruptly closed the Chinese embassy in Houston. Beijing called Washington's order to close its consulate in Houston an unprecedented escalation by the U.S., and reports said Beijing was considering shutting down the U.S. consulate either in Wuhan or Chengdu in retaliation. I'm sure that most of you recognize the province of Wuhan, and this is where the novel coronavirus was first identified. Cutting off U.S. involvement in the province of Wuhan could be very detrimental to the U.S. at this moment. We're still working on a vaccine. We're still identifying new strains of the virus. And without that tie to the province where this all originated, I think would put the U.S. at a distinct disadvantage in its fight against coronavirus. According to Axicorp's chief global market strategist, Stephen Innes, the escalation in U.S.-China tensions is a reminder of the headline risk faced by investors during the upcoming U.S. election campaign. The U.S. and China have become increasingly combative in their views this year. The markets better get used to it because there's more of that to come. That sounds really foreboding, but I don't think that he's wrong. I think that there is a distinct possibility that tensions will increase, and I think we need to be prepared for that. Stock futures were higher Thursday as investors on Wall Street weighed mixed earnings reports and the possibility of more government stimulus against the rise in tensions. Contract links to the Dow Jones Industrial Average were up 94 points, S&P 500 futures gained 11 points, and NASDAQ futures rose 91 points. Stock closed higher Wednesday, and for the S&P 500 rose for the fourth consecutive session, despite the escalation of tensions between the two largest economies in the world. Seemingly, the biggest news on Wall Street is the tension between Apple and Goldman Sachs. I thought Apple was doing well. They closed at $389 per share on Wednesday, which is up roughly 33% year to date. Sounds to me like they're on an upswing. I'm looking forward to the next generation of the iPhone. It's going to have 5G. It's going to have a better processor. Sounds pretty good. Also looking forward to the new generation of the Apple Watch and the iPad. Question is, when will I be able to get my hands on it? Not just whether or not I can afford it, which we're going to talk about later, but when is it going to be released? And that's where Goldman Sachs really starts to worry. Apple's earning report is coming out on the 30th, but Goldman's analysts are mainly focused on forward guidance, or their lack of it. The firm does not expect Apple to reveal an official forecast for its next quarter, which is going to leave investors in the dark as to whether its fall iPhone launch will arrive on time. They're expecting this report to be a little thin. Just a 1-month holdup could prompt a 7% hit to revenue and 6% drop in earnings over the final quarter of 2020, according to Goldman. Such a delay, while not yet the firm's baseline scenario, would worsen an already dire projection. Goldman's analysts see demand weakening through the end of 2020 and leading next year's profits to slide 16% below Wall Street's consensus. According to Rod Hall of Goldman Sachs, on the basis we see Apple's recent stock performance and absolute trading level as unsustainable and would continue to recommend that investors avoid the stock. Yikes. Goldman maintains a sell rating on Apple shares. The firm bumped its price target to $299 from $268 in the Wednesday note, hinging on the update on a higher S&P 500 price earnings multiple. The new target still implies a 23% drop from Wednesday's close. Results for the quarter that ended in June are set to meet expectations, Goldman said, but the focus is going to remain on late 2020 for insight into Apple's demand recovery. Recent higher income job cuts at companies and a still elevated level of unemployment, like we've just talked about, suggests that the coronavirus's drag on spending will last longer than first expected. Even if unit demand swings higher, Goldman sees a weakened average selling prices weighing on Apple's performance well into 2021. Basically, what Goldman is predicting is that because of the unemployment, because of the instability. People are going to focus on paying their power rather than buying the new iPhone, especially if their current iPhones are in working order, which, let's face it, usually they are. Usually we just want to get our hands on the new tech and see what's fun in the latest iteration. Apple would have to retrace to prices seen in early May to hit Goldman's price target. So, will Apple ever be able to make its mark? I really think so. I think that this is just a temporary setback for Apple. I think Apple has one of the industry's best brand loyalty. And I'll say this as an Apple user. I was tempted by Samsung's slick interface and gorgeous phones. And I've probably owned 2 Samsung Galaxies in my past, but I always seem to return back to the iPhone and the Apple Watch and the iPad and the Mac because the integration is seamless and I just love Apple products. And I'm not alone. I think the majority of Apple owners give Apple a cult-like following, especially CEO Tim Cook. So right now we're going to take a quick commercial break, and when we come back, I'm going to be discussing the winners and losers on earning reports that were out this week. So stick around.
Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered.
Welcome back. If you joined me last week, I gave you a sneak peek at the earning reports coming out this week. Today, we're going to take a deep dive in the most interesting reports that came out Monday, Tuesday, and Wednesday. We're going to start off with Coca-Cola. Whether you call it Coke, soda, pop, it's my favorite fizzy beverage. On Tuesday, they reported its largest decline in quarterly revenue in at least 30 years. But the company sees demand improving as global lockdowns ease. CEO James Quincey said the company believes the second quarter will likely be its most challenging of the year and expects to do better in the next. Shares of the company rose 3% in the morning trading. Here's what the company reported compared with what Wall Street was expecting based on the survey of analysis by Refinitiv. The earnings per share ended up being 42 cents adjusted versus the 40 cents expected. Revenue was $7.2 billion versus the $7.2 billion expected. Coke reported fiscal second quarter net income of $1.78 billion or 41 cents per share, which is down from the $2.61 billion or 61 cents a share a year earlier. Excluding items, the beverage giant earned 42 cents per share, topping 40 cents expected by analysts surveyed by Refinitiv. The bottom line is that Coke indicated that it sustained elevated sales of its product for at-home consumption, which has helped it to recover since the pandemic forced consumers to hunker down at home this spring. The number of cases of drinks sold by Coke and its bottling partners was down about 10% in June, but it was a marked improvement from April's roughly 25% decline. The company investors are optimistic. They believe the second quarter is the bottom of the barrel for Coke. And with hopes of a vaccine, Coke may be able to come back much stronger in the third quarter. So here's hoping. Next, we're going to look at IBM. IBM was the first cloud service to report. And it's fair to say that Wall Street has its head in the cloud. Adjusted earnings per share were down 31% on an annualized basis in the quarter, and revenue declined 5% according to a statement. It's the company's second consecutive quarter of revenue decline as the coronavirus hit the company's results. But, hear me out, they beat expectations for both earnings and revenue set out by Refinitiv. Earnings actually came out at $2.18 per share adjusted versus the $2.07 that were projected. The revenue was also higher at $18.12 billion as opposed to the $17.72 billion that was expected. The company's net income, which came out to $1.36 billion, was down 46%. However, the company improved gross margins in 3 of their 5 units. IBM's total gross profit margin was 48%, up from 45.1% in the first quarter, and up from 47% in the year-ago quarter. Smaller businesses, who are really the ones that are suffering the most, canceled and delayed their orders and really cutting IBM's net income. But IBM is prepared for the pandemic to continue for a while longer and has made accommodations for workers telecommuting. It's likely that we see that the economic recovery is looking to be longer and more protracted than we might have hoped for back in March, according to Arvind Krishna, who replaced Ginny Rometty as CEO in April. IBM's cloud and cognitive software segment, which includes Red Hat, produced $5.75 billion in revenue. That's up 3% and barely above the $5.74 billion fact sheet consensus. Red Hat revenue was $1.09 billion on a normalized basis, up from 17%. Red Hat's growth rate was down from 18% in the first quarter. Microsoft's earnings for their fourth quarter and full year. Overall, the report was better than expected, except in one key area, but stocks fell 3% in aftermarket training. So it's not all great news. Earnings were $1.46 per share adjusted versus what Refinitiv was calling for at $1.34 per share. As expected, the revenue was $38.03 billion versus $36.5 billion as expected by analysts. I can never say that word. According to Refinitiv. The street's love of the cloud didn't give Microsoft the same bump it gave IBM. Microsoft Intelligent Cloud Business segment, which includes Azure Public Cloud, Windows Server, SQL Server, GitHub, and Enterprise Services. They posted $13.37 billion in revenue, up only 17% year over year and above the $13.11 billion consensus among analysts polled by FactSet. Azure revenue growth slowed from 59% in the previous quarter. Microsoft does not disclose Azure revenue in dollars, but did say its commercial cloud business surpassed $50 billion in revenue for the fiscal year. Like IBM, Microsoft has a big problem when it comes to its smaller consumers and businesses. They're just not purchasing software, cloud service, or really much of anything new. With Office and Windows, their productivity and business processes reached $11.75 billion in the fourth quarter, missing estimates of $11.9 billion. For the second quarter in a row, Microsoft said it experienced a slowdown in transactional licensing, especially for small and medium businesses. And that really means that instead of purchasing new license for Microsoft Office Suite, I'm going to stick with what I've got, or even maybe use the Google Office Suite, which is free, if I don't have enough money to purchase new licenses for everyone in my company. Micro said the slowdown contributed to a 34% decline in revenue for Office products used by businesses, reflecting the continued consumer shift to cloud offerings for multi-year on-premises agreements. Transactional licensing refers to the traditional one-time purchase model. On June 26, they announced it would close its physical stores, resulting in a one-time charge of $450 million, or 5 cents per share before taxes to its investors. They also cut a small number of jobs. The Productivity and Business Processing Unit contributed $11.75 billion in revenue, and that's up 6% and less than the FactSet consensus of $11.91 billion. LinkedIn's revenue grew 10%, the slowest growth since 2016 as Microsoft closed the $27 billion acquisition. And now we're going to move on to the rock star of earnings, and that's going to be Tesla. Tesla announced Wednesday after the close, and its stock rose 6% in the after-hours trading and will now be featured on the S&P. The company beat expectations and reported its fourth straight quarter of profits. Their earnings were up $2.18 per share versus the 3 cents per share that were actually expected. They blew it out of the water. Their revenue was $6.04 billion versus the $5.37 billion that was expected. And they had a net income of $104 million. Tesla also reported its first full year of profitability on a GAAP basis, which now means that they can be considered for inclusion on the S&P 500 index. Automotive revenue declined by 4% year over year for Tesla, from $5.38 billion to $5.18 billion, despite the company adding a new crossover SUV to its lineup, the Model Y, and opening a new plant in Shanghai in the past year. In the year-ago quarter, Tesla reported $111.2 million in revenue from regulatory credits. That number nearly tripled to $428 million in regulatory credits in the second quarter of 2020. At this time last year, Tesla shares were trading for about $260. Now they're trading above $1,500, making the company the most valuable automaker in the U.S. by market cap. During the period ending June 30th, 2020, Tesla grappled with the effects of the COVID-19 pandemic, widespread civil rights protests on its employees and customers, and U.S. factory operations especially. During Tesla's earnings call, CEO Elon Musk announced that they will build its newest gigafactory near Austin, Texas. The area is going to take up about 2,000 acres, and will be roughly 15 minutes from downtown Austin. Elon Musk said the factory will be, quote, an ecological paradise, end quote, and that it will be open to the public. Musk also added that Tesla will continue to grow in California. It will build the Tesla Model S and Model X for global deliveries, and the Tesla Model 3 and Tesla Model Y for North America in its California plant. So I think that's huge news. Tesla is making incredible progress, and I can't wait to see what else Elon Musk is going to come up with. Snap, the company behind our favorite Snapchat app, had a very disappointing earnings report for the end of their second quarter. Snap stock dropped Wednesday after the company reported second quarter results late Tuesday that beat Wall Street estimates, though it did have some elements of concern to analysts. Daily active users on the app rose by 9 million over the quarter, taking the overall total to 238 million, which is a 17% improvement from last year, but it's not quite as many users as analysts were anticipating. The company noted that the initial quarterly boost, triggered by stay-at-home orders during the peak of the pandemic, dissipated faster than they anticipated once the lockdowns began to ease. So people went back to work and left their Snapchat at home. However, Facebook's loss is Snapchat's gain. Snap Chief Business Officer Jeremy Gorman said although it was difficult to determine the exact revenue impact of the boycott so far, the conversation has opened the door for Snap to have conversations with high-level executive at brands. So they may be taking over Facebook's market share, or at least that's what they're anticipating. What we do know is that it's always positive to engage at the highest levels of an organization, and this conversation has opened the door for them to do that extremely frequently at the CEO and CMO levels. It's an opportunity for the company to promote itself as being hand-curated and safer for brands. There's no town hall or ability for unvetted users to post to our whole community. So you won't run into the problems that you see with Facebook and Twitter. And advertisers evaluate platforms which align with their values. So since you can really curate your own space on Snapchat, it makes it more appealing to advertisers who may have morals more aligned with the users. I think Snap will really bounce back in the third quarter because they're going to be adding more features to the platform. So it's not going to just be disappearing pics. Monday, Snap launched Minis, tiny apps that you can use within its chat feature without having to download anything. For its first Mini, Snap is partnering with Headspace, the popular mindfulness meditation app, where a soothing British voice will tell you how to breathe. It sounds wonderful. Headspace Mini offers 6 different 3 or 4 minute meditation sessions with titles like Just Breathe, Get Out of a Funk, and Me Time, #sassy. Meditate with friends, or at least with their Bitmojis. This is some win-win brilliance here. With Minis, Snap could theoretically let you do 100 times more things in their app, which could lead to 100 times more engagement and a lot more ad revenue. By adding a popular partner like Headspace, Snap can draw users to Minis. By offering itself for free, Headspace gets free marketing and exposure to Snap's 200 million users. For Headspace, it's all Robinhood Snacks thinks this could be the next mini app store. Call it the Snap Store. Apple takes a 30% cut of paid downloads, in-app purchases, and subs in the App Store. So Snap could really make a good profit off of this. Developers have long complained, but don't really have another choice. Now Snap is offering a platform to ship mini apps, which could be monetized later. Consumers would rather do multiple things in one app than download dozens of apps. We're going to take a quick commercial break, and when we come back, we're going to discuss the economic recovery and what that means for each and every one of you. And if you stick around till the end, I'm going to give you my top 10 finance apps. So stick around.
Tired of searching the vast jungle of podcasts? Now listen close and hear this out. There's a podcast network that covers just about everything that you've been searching. Hey! The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter, and download us on iTunes, SoundCloud, and Google Play.
Welcome back. In our last segment, we talked about the earnings reports that were out early this week. The recovery is happening. As many Americans continue to suffer, the recovery is not happening as fast as we would like, maybe not where we would like, but it's happening. So, what's working and what's not? Let's just start first in Washington. In Washington, there's going to be a second stimulus, and that's going to be good for everybody. The Senate is back in session this week, and its top priority is to hash out the next coronavirus stimulus package. Most of the relief measures put place in March via the CARES Act will expire soon, including enhanced unemployment benefit and an eviction ban on federal housing. But state reopenings have stalled as coronavirus cases have exploded. Senate Republicans announced Wednesday evening that they have reached a fundamental agreement with the White House negotiators on how to move forward with a coronavirus relief bill. After the third meeting this week, Senators Richard Shelby from my state of Alabama, the chair of the Appropriations Committee, Lamar Alexander of Tennessee, the chair of the Health and Education, Labor, and Pensions Committee, and Roy Blunt of Missouri, the chair of the Rules Committee, emerged from the negotiating room with Treasury Secretary Steven Mnuchin and White House Chief of Staff Mark Meadows, saying that they are completely on the same page and in good shape. The GOP proposal will call for at least $500 billion in new spending, despite strong oppositions from some conservative Republicans. This total covers hundreds of billions for the Health and Human Services Department and Pentagon, farmer and infrastructure programs. States will get $25 billion to improve coronavirus testing, while tens of billions more will go to the National Institutes of Health, community health centers, and other health programs. The Senate Republicans' proposal also allocates $105 billion for reopening schools, which is a top priority for Republicans who want schools to reopen with in-person instructions and get more money. As a parent of a school-aged child, I am kind of torn on this issue. I would love to see my stepdaughter go back to school because she is really missing her friends and that interaction that you just can't get with your older brother and your parents. But at the same time, letting her get exposed to the risk of the virus is really scary, and I don't want to bring the virus home, or I don't want to bring it to my parents. It's a catch-22 because there's no good way to go about this. So the best thing that we can do right now is to really focus on schools and give them more money to make sure that they can keep our classrooms cleaner and that they can move students and have fewer students in a classroom and be as safe as they can possibly be. And if it's required, we need to put money into distance learning. In the state of Alabama, we have a lot of areas that don't have great access to the internet, and that's been a problem with the distance learning. So again, here we are with no real clear solution. So we just need to really gather as a country and do the best that we can. Getting back to the Senate Republicans' proposal, there is an eviction ban because the federal and statewide eviction bans have already expired or will expire at the end of the month, which will leave potentially tens of millions of households vulnerable to eviction and homelessness. Almost a third of households missed their housing payments at the beginning of this month. It's likely some sort of type of housing relief bill will be included in the next bill. The question is how much aid will be earmarked for housing initiatives. And that's really what we don't know. If you tuned into my podcast last week, we discussed the payroll tax deduction. Payroll tax deduction is not going to happen. although workers would see a 15% increase in their take-home pay, it would place too much stress on the entitlements like Social Security, Medicaid, and Medicare. The good news for everybody is that Treasury Secretary Steven Mnuchin said that we should expect another round of stimulus checks. But he's not really given us a complete outline of who's going to get it and how much the checks are going to be. As far as unemployment insurance, as we've already discussed, the jobless claims were announced Thursday, and more people are have made unemployment claims, and 25 million people are still receiving that extra $600 per week in federal unemployment insurance. And that's set to end this week. And that is a huge reduction of benefits. So we're not really sure what's going to happen with that as of the recording of this podcast. So that remains to be seen. And I will put an update either on our Twitter feed or we'll discuss that in our next pod. The Paycheck Protection Program, run by the SBA, will receive another $90 billion to make loans, including to companies who have already received money. There still remains $100 billion of unset PPP funds, which will cover the cost of the new effort. So looking back on who received PPP and who hasn't, one of the first industries that comes to my mind is the bailout that we did of the airline industry early on in the pandemic. Travel is really difficult right now. I live in Alabama, and as I said, I grew up in New Jersey, and I've got friends in the tri-state area, New York, New Jersey, and Connecticut. And if I wanted to go visit friends, I couldn't right now because I'm actually banned from visiting those locations. So travel for leisure is almost non-existent unless it's by car. I can't travel internationally, and I guess it's disappointing because I really have a little wanderlust. I mean, I've been locked up in my house for like 4 months. So, you know, it would be so nice if I could just go on a vacation with my family. But if I have to fly there, that's just not going to happen. The pandemic has had severe consequences for the airline industry. Back in April, the airlines got a $25 billion bailout. They were supposed to continue paying their employees. Under the terms of the bailout, they can't make any layoffs or job cuts until September 30th, which is really just around the corner. The hope was that the funds would be enough to tide airlines over until October, when travel was expected to pick up again. But I don't see that happening. While travel has ticked up from mid-April, when the airlines had 96% fewer passengers than they had in April of 2019, it's still pretty abysmal. Airlines generally maintain narrow margins. Industry average operating margins were around 7% in 2019, with a net profit margin of around 4 to 5%. So a 10-point decline in revenue could wipe out profits entirely. On July 16th, the number of passengers passing through TSA was down 74% from normal times a year ago. COVID cases are surging again, so it doesn't seem like this trend will end anytime soon. And that's pretty sad. With depressed travel demand and high expenses, U.S. airlines are burning through that bailout money. Now, tens of thousands of employees are fearfully waiting for October 1st when the ban on job cuts expires. American warned 25,000 employees, almost 20% of its workforce, about potential cuts, citing an 80% drop in sales. United told 36,000 employees, almost 40% of its workforce, that they could be furloughed. Southwest, which never had an involuntary furlough, told employees that cuts will happen unless passenger numbers increase 3% 3 times rather, by the end of the year. Delta, which took a $5.7 billion loss last quarter, might have to cut pilots' pay to avoid furloughs. JetBlue has also not set warnings to employees, but is working to reach a deal for thousands of workers to accept voluntary leaves or buyouts, according to a memo that was obtained by Bloomberg News. The company also reached an agreement with its pilot union to avoid any involuntary furloughs until May 2021. Airline unions have asked Congress to provide another $32 billion to stave off the cuts and keep workers employed through next spring. The union recently gained an ally in Representative Peter DeFazio of Oregon, the chairman of the House Transportation and Infrastructure Committee, who urged his colleagues to respond to the ongoing economic crisis. So, where does that put our lawmakers? Was the bailout a waste of $25 billion? It looks like the jobs that we tried to save are just going to be cut 6 months later. It's even possible that the airlines will still go bankrupt. But if the government hadn't bailed out the airline industry, that could have all happened 6 months ago, and that meant government money going to workers through unemployment checks. So with the bailout, the government gets to continue collecting the income taxes from those employees at least until September 30th. So it's really all up in the air, no pun intended. And where we're going to go from here, who knows? Honestly, I'm not a huge fan of the airline industry, just because I'm not a person who enjoys the process of flying anymore. I'm a Gen Xer, and back when I was a kid, I could go on an airplane, get a meal, get a whole can of Coke to drink, and had a lot more legroom. I don't know if that was because I was a kid or if it's because the seats are a lot smaller now. But, like I already said, their profit margins are so narrow that they really had to make those cuts in luxury. So, we're left with an industry that is pretty precarious. So, Wall Street is reacting to this, as you would expect. Shares of Delta are down 55% from this time last year. American Airlines dropped 60%. United Airlines has fallen 64%. And Southwest, which is my favorite airline, managed to have a slight decline of only 38%. Long-term investors should consider the evolving industry fundamentals and compare those to historical figures. What results do the airlines need to report to domestic passengers? We really don't know. It's not as easy as us going back and saying that the airlines need to have X number of revenue. Because of the situation that they're in, because of the bailout, it's really going to be precarious. So they may be eligible for PPP loans, and that may put off the layoffs that are expected on October 1st. They also have access to other provisions in the CARES Act. American, Spirit, Hawaiian, Frontier, and SkyWest were able to hash out loan details in early July. So don't count the airline industry down and out just yet. So I never like to end a segment on a bad note. So let's look at what industries are really profiting during the virus. Construction industry. Home building is booming. If you listen probably really closely to this pod, you may be able to hear the construction that's going on behind my house right now. So, that's booming. It gives people a job, and the housing market with the low interest loan is really not as bad as it could be. Online retailing is also doing great. Amazon continues to be a juggernaut, while overall, the sales growth in Amazon has been huge over the last decade. They received a really big boost from quarantine because we couldn't go to stores. On March 12th, the beginning of the lockdown, the company's stock was priced close to $1,676.61. By the end of June, it was nearly $1,000 higher than it was just a few months prior. I may or may not have increased my Amazon spending. I don't know. I'm just saying. The other success of the pandemic is workspace solutions. Out of necessity, businesses are moving to more and more remote and flexible workforces. A lot of companies are even second-guessing their real estate investments because workers have been so productive at home. Having the right technology is super important. Zoom became a video conferencing leader during the COVID-19 crisis. In fact, Zoom's adoption rate surpassed previous industries' frontrunners, GoToWebinars, and Cisco during the past 3 months when companies scheduled virtual meetings. And I have to say, I have a personal preference for Zoom. I think it's a lot easier, and I have had a lot of Zoom meetings in the last 4 months. I've had Zoom meetings. I've had virtual class reunions. My family had a virtual Mother's Day party. And honestly, I'm really thankful for that app. Speaking of apps, we're going to take a quick break. And when we come back, I'm going to have my top 10 investment apps.
Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming, to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand.
Welcome back. In our last segment, we talked about how fragile the economy is and how that's impacting everyone. If this is your first time joining us, for our last segment, I always give you my top 10. This episode, we're talking about my top 10 investment apps. Because if you got a little money that you don't need to use right now, it's not a bad time to invest it. So we're going to start with E-Trade at number 10. E-Trade is the granddaddy of all investment apps. Everybody's heard of it. Everybody's seen it. It has 3 trading platforms, the E-Trade Web, Power E-Trade, and E-Trade Pro. They're all free and available to all customers. They do not require any trade activity or balance minimum. So E-Trade Web offers free streaming market data, free real-time quotes, live market commentary, analyst research, stock screeners, and more. From the dashboard, you can track your accounts, create watch lists, view market data, and create some pretty complex option strategies. eTrade Pro, the company's desktop platform, is also really impressive. They have idea generating tools like the strategy scanner and backtesting capabilities. And for the truly active trader, eTrade has their Power eTrade, the result of the company's acquisition of Options House several years ago. The web platform offers real-time data, more than 100 technical studies, over 30 drawing tools, streamlined trade tickets, customizable options chain views, and trading ladders. But the downside is that it's a little difficult to use, which is why it's at number 10. Number 9 is Stash Invent. Stash aims to make the process of selecting investments, specifically stocks and exchange-traded funds, quick and easy for beginners. Cost $1 per month for a brokerage account, plus access to Stash's online bank account and debit card, which includes a rewards program. The minimum balance is $0, and because Stash offers fractional investings, where you can buy portions of a company stock or a fund share for pennies, Stash offers other account options too. For $3 a month, you can get a brokerage and bank account, plus a retirement account, either a Roth or traditional Roth IRA. For $9 a month, Stash offers all of the above, plus 2 custodial accounts for minors, a metal debit card rather than plastic, a turbocharged rewards program, and a monthly investment research report. Stash is really best for investors who want guidance selecting investments. However, there is no investment management, and they have ETF costs. So it's not an app that is perfect. So, at number 8, we've got Acorns. And Acorns really could have been on my last top 10 list, where I gave you my top 10 personal finance apps. It's really easy to use, and you don't have to pay a lot of attention to it. You just put your debit or credit card and link it to the account, and Acorns will take off. It'll round your purchases up to the next dollar, so it'll take all of that coin and invest the difference into one of a few ETF portfolios. The cost is $1 per month for Acorns Invest. If you want to take a step up, you can move to Acorns Later, which is bundled with Acorns Invest for an additional $1 per month. Acorns Later is the company's version of an individual retirement account option. So they give you 3 options for the retirement account: traditional IRA, a Roth, or a SEP. You can even roll over an existing 401k into Acorns Later. Acorns will choose your portfolio based on your targeted time until your retirement, which they aim for the 59.5 age, where that's when you can withdraw from your IRA. So it's really a good focal point for a non-work-based IRA. For an additional $1 a month, you can add Acorn Spends, which is gives you an FDIC protected checking account with a debit card. So if you really want that automatic savings, Acorns is really a great app for that. Number 7 is the You Invest by JP Morgan Chase. It has complete integration with the Chase mobile app, and Chase Mobile is probably my favorite of the big banks' mobile apps. It's easy to use. So if you have a Chase mobile app account, you can set up a You Invest pretty easily. But that's not to say that those who don't have an existing account with Chase, are prohibited from using that. You can also set up just a You Invest account. You Invest has no trade commissions, so you are eligible for option trades, and and they charge a competitive 65 cents per contract. They also do not charge a fee to purchase fixed income investments like bonds and mutual funds, which is something that I think everyone should keep an eye out when we've got an unstable economy. They also have other $0 commission on brokers. There is no account minimum, making any money you've saved enough to start investing. You can invest as little as $1 in no-load mutual funds with no transaction fees. So that really seems to be a good deal for people who are just starting out. They also give you access to the prospect of building an entire portfolio from scratch. They have a tool that makes the process easy and less intimidating. What they'll do is they'll give you a quiz that determines how your assets will be allocated based on your risk tolerance and goals. So use that allocation as a framework when you search, compare, and choose investments. While You Invest Trade accounts give investors access to other investment types, including bonds and mutual fund, the Portfolio Builder tool allows you to choose and trade only ETFs and stocks. Where it falls short, again, is investment selection. While You Invest Trade may be an excellent choice for the beginner, it's not great for an advanced investor. It doesn't support investing in futures or alternative investments like cryptocurrency. They also have a higher minimum for Portfolio Builder. They require a $2,500 amount in your account to use it. So there are a lot of cons to this. And again, that's why it's not that high up on my list. So number 6 is wealth-based. Wealth-based is kind of like the Facebook of investment apps. It's a new app, and it's probably the most user-friendly app out there for having fun and picking stocks. You can set up games with friends to last however long you want, a few days, a few weeks, or even just till the end of the day. 2 things set wealth-based apart in the stock simulator world. First, the app marries social media with stock picking. You'll see a feed of stocks your friends are picking with daily updates of who's winning and even a little friendly trash talk. Second, the app runs really well. No delays to load or anything like that. So if you're not a huge stock picker, you can have fun here, get a little practice, and get your move on. So, it's just a fun little app. It's not going to really make you any money, but it's good for beginners just playing around. Number 5 is SoFi Active. It's a new offering from SoFi Invest, squarely aimed at young investors with free trades of stock and exchange traded funds, the ability to buy and sell cryptocurrencies like Bitcoin and Ethereum, and fractional shares of blue chip companies like Amazon and Netflix. So that's really our first entry on the list that gives you access to the cryptocurrency world. If you tune in next time, I'm going to give you my top 10 cryptocurrency apps, and SoFi may just be on that list. This is a self-directed brokerage, so you're not really getting a lot of support, but there are robo-advisors through SoFi's automatic investing and online cash management account, SoFi Money. SoFi Active Investing is best for active traders, ETF investors, fractional shares, cryptocurrency, tradable securities. SoFi Active Investing may be leading the way with fractional shares and cryptocurrency, but the brokerage is behind the wave in other investment options. You can't really do a lot of purchasing mutual funds, index funds, and bonds. So you have to look elsewhere if that's really where you're looking. But again, you've got the option of buying crypto. So that makes SoFi a little bit more attractive. Number 4 is Betterment. Betterment is best for low cost. It is a robo-advisor, and it's one of the largest and most popular. The app provides professionally managed portfolios using a selection of ETFs and is calibrated against your own risk. So, if you're willing to stomach a little more risk, the app can find you a higher return. That's pretty simple. If you need a safer portfolio, we can do that too. You can set up a Betterment and kick back while the pros do the rest of the work. Charges you a smaller price than you pay for a traditional financial advisor. Yikes. Management fee for the basic account amounts to 25%. I'm sorry, 0.25%. So it costs $25 annually for every $10,000 you have invested. But you do have to pay extra for the ETFs that Betterment invests in. The app lets you set goals to invest, such as a safety net for retirement, and there's really no account minimum. So it's a nice little app. Number 3 is Charles Schwab. Charles Schwab is one of several brokers that are now commission-free. Options carry a competitive contract fee of 65 cents per contract, which is in line with other brokers. Mutual fund and expenses are available through this app with over 3,500 no transaction fee mutual funds, and within its own proprietary lineup of index funds and ETFs, Schwab now offers some of the lowest expense ratios available. The selection is also easy to navigate. Schwab's ETF select list helps you narrow the choices, featuring picks for the best fund in selected categories. You can sort by feature, including expense ratio, Morningstar category, and benchmark index. There's also the personalized portfolio builder tool designed to help you create a diversified portfolio based on your financial goals, risk tolerance, and time horizon. Schwab's investment screeners are easy to use and lets you save your screens. Select lists, like previously mentioned for ETFs, are compiled by companies' experts and released quarterly to give you a pre-screened selection of mutual funds and ETFs. The company is also integrated with Google Assistant. You can ask Google for stock quotes, general market updates, and more, and has an Amazon Alexa skill that provides similar information, including the ability to create and get updates on a watch list. So, the other great thing about Schwab is that there's no account minimum. So, you've got a app that's really completely integrated with your entire life. It does have a premier offering called Street Smart Edge, which is a customizable platform. It comes with downloadable software, so it's not as much of a on-the-move kind of app. And a suite of programs called Street Smart Central. It's designed for other advanced features and charting tools. So this is really for the advanced investor. I think this is a nice nice app. It does offer fractional shares for all S&P 500 stocks, so you have a really good variety of fractionals. But it has a really low cash sweep rate, so uninvested cash in the brokerage account is swept into an account paying less than 0.5%. But it's definitely an option. Number 2 is Robinhood. Up until I was making this top 10 list, Robinhood was my favorite. It's easy to use. You open up your account, and if somebody refers you, they will get a share. You have ETFs, options, cryptocurrency for free. They are also allowing for fractional shares if you qualify. So it's not open for all investors, but qualified investors. It has a nice interactive interface, easy to use for somebody who's not quite as savvy. And you can access your stocks page from a search bar at the top of the screen, pull down charts, visual statistics. You know, I love some pie charts, all in the Robinhood app. Robinhood is a great starter investment app. It's where I started with my online investments. My number one app kind of surprised me because I've always been a fan of the Robinhood. But when I did my research, I learned about Fidelity. So Fidelity has been a leader in the low-cost commissions, but it did away with commissions completely in October of 2019. Before that, the company did away with nearly all account fees. So you're basically just playing with your own money and not giving it any of it to Fidelity. They have a high cash sweep rate. It automatically directs all cash in new retail brokerage and retirement accounts into its Fidelity Government Money Market Fund, SPAXX, which had a 1.61% interest rate as of October 2019. You can sweep cash into a lower rate FDIC insured account instead. Access to mutual funds in a manner that none of the other accounts or other apps can really do. It's the first broker to bring to market index funds with absolutely no expense ratio. You can really set up a virtually free retirement portfolio. And it gives you a lot of options for setting up a really sizable retirement. You have access to over 3,500 no transaction fee mutual funds and over 700 mutual funds and indexed funds with expense ratios of 0.5% or less. Those funds come from Fidelity and other mutual fund companies. It offers a large selection of funds with low or no minimum. And it's really just a good overall app, focusing on the mutual fund companies, which is if you are a risk tolerant, if you're not a risk tolerant investor, the Fidelity app is really the number one app. So that's my top 10, but I'd be remiss if I didn't add some of the new up-and-comers. M1 Finance app is good for fractional shares. You've got Webull, who is a pretty decent Robinhood competitor, and Yield Street, which I think everybody should take a look at. So that's the end of my show. Thank you so much for joining me on the GSMC Financial News Podcast. Join me next time for the word on the street, and I will give you my top 10 cryptocurrency apps. Find us on your favorite podcast app and write a nice review. That would really help us. Also, if you can please follow us on Facebook, Twitter, and Instagram. I'm going to put a list of my top 10 finance or investment apps on our Facebook and Twitter feed as soon as possible. So, you can also reach me there if you have any questions. And I appreciate your time today. And please join me next time. See ya.
You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.